makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that senior U.S. officials are preparing for the possibility of a strike on Iran in the coming days. Now, President Trump has publicly considered an attack, saying he has ideas as to what to do and that all options remain on the table. Now, Trump met with top advisors to discuss those options, but says he's yet to make a final decision. He also says Iran is ready to negotiate.
Iran's got a lot of trouble, and they want to negotiate. And I said, why didn't you negotiate with me before? All this death and destruction. Why didn't you negotiate? I said to the people, why didn't you negotiate with me 2 weeks ago? You could have done fine. You would have had a country.
Well, Jumana Raseche, of course, based in the Middle East, has more. Jumana, good morning. So how likely is a U.S. military intervention in this conflict? And what's Iran saying?
Well, at this point, it seems quite likely, Francine. U.S. officials told Bloomberg in a story that we reported overnight that they are working on plans to start their military intervention as soon as the coming days. Possibly could be looking at action if it does happen over the course of the weekend. Now, those officials also did stress that the plans are in a state of evolution. They're still fluid. And of course, there hasn't been an ultimate authorization to act on those plans. The decision ultimately does lie with the U.S. president. He was asked about it yesterday. And again, similar to the ambiguity that has been shrouding his decision-making the last few days, he also said, I may do it, I may not. A final decision will be made even 1 second before it's due. So that's not very helpful in terms of thinking about what the U.S. president has going on in his mind right now. But from the Iranian side, we heard from the supreme leader, the Ayatollah, yesterday in televised remarks, and he said that there will be no option of a surrender. They will not capitulate. They plan to fight hard, and they'll be watching what the U.S. do very closely, because if the U.S. join in the bombardment, is what they say, they will then cause, quote, irreparable damage on U.S. assets, and that the response will be proportional. So the region, Francine, is on a high state of alert right now.
It certainly is. Jumana, is there a way of actually de-escalating this through the diplomatic route?
The Iranian Foreign Minister Abbas Araghchi put a post out on social media yesterday saying that they are still keen on pursuing the diplomatic channel, which is somewhat at odds with the remarks that the Ayatollah himself delivered, which were remarks of defiance. And actually, interestingly enough, there are reports that the Iranian foreign minister will be meeting with the foreign ministers of UK, Germany, and France, possibly in Geneva tomorrow, to talk about the nuclear deal. So there is perhaps a sliver of hope that the diplomatic channel can be pursued. Whether the U.S. wants to go in that direction ultimately the decision does reside with the U.S. president. Earlier on in the week, he seemed to want to perhaps look in or renew the possibility of bringing Iran to the table, taking advantage of this moment of vulnerability from the Iranian regime perspective to perhaps demand more onerous criteria when it comes to those nuclear deal discussions. But over the past 24 hours, it's pretty obvious that his stance towards the region has turned a lot more hawkish, which is why, as I said, the region is bracing itself for the real possibility that the U.S. get involved.
Jumana, thank you so much. Jumana Raseche there with the very latest from the Middle East. Now, to talk about geopolitics, but also to talk about everything banking, because we have two stories from central banks today. Norway, we thought, would have kept waiting before the first interest rate cut. Not so. They cut to 4.25%, and they also said that they can continue doing so this year. And then the earlier story was that SNB was introducing in Switzerland stealth negative rates to keep money markets going. So I'm delighted to be joined by Jari Stehn. He's chief European economist at Goldman Sachs. Jari, thank you for joining us. There's a lot, right? There's the Middle East concerns, of course, about what happens to the price of oil and inflation. And then there's this central bank news with you see a divergence of central banks. What do you think will mainly drive the economy over the next couple of months?
Yeah, as you say, a lot to digest here. I would say focus is on the increase in energy prices very much at the moment. That's clearly going to have an upward effect on headline inflation, is going to act as a little bit of a headwind to growth. So it might reinforce some of the concerns that are coming from the trade side, acting to be slightly inflationary and weighing on growth. But I think we should also keep in mind that, of course, for now, what the energy price increases have done is really unwind the declines that we saw in April and in May. And so, roughly speaking, energy prices are back where they were in the first quarter. And so I think for now, it's not going to be the driving force for what central banks will do. More important, I think, are still the trade tensions. And of course, we heard that yesterday from Powell. We are seeing that also, of course, in the commentary by the European central banks, that there's still a lot of uncertainty around this. I think, generally, I think for Europe, it means weaker growth, weaker inflation, and is probably going to keep a downward bias on rates across Europe for now.
Yeah, on the price of oil, I mean, is there an assumption that Donald Trump just can't afford for oil prices to go at 150? So even if something happens with the Strait of Hormuz, Saudi Arabia would be pressured into doing something. So is it a concern that is bubbling, but is there an assumption that actually will be dealt with?
I think that's probably right. I mean, it's obviously a very fluid situation right now, but the scenarios that we have set out, our commodity experts, is, upside scenario, for example, where oil goes to 90, but then doesn't stay there very long, because, as you said, there's an assumption that broader OPEC supply of oil would then come through. So we think of it as something that's going to matter for headline inflation, for energy prices, but it's probably not going to be something that's really going to derail the outlook here.
So, Jari, let's go back then to central banks and actually inflation. And as you say, the impact of tariffs and trade. This is what Jay Powell said yesterday.
The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
I mean, we heard it pretty clearly. There's not much certainty on the U.S. economy, except for the fact that Jay Powell thinks prices will go up. What does it mean for the rest of the world and Europe?
Yeah, I mean, so just on the Fed, I mean, we expect that they will take the time a little bit. We think they will cut in December. Yeah. So they're in a good place now. They want to see more evidence about the effects of tariffs on the economy. I think the European central banks are generally still in the mode of cutting rates. Mm-hmm. Now, the Bank of England today, of course, is going to pause. Yep. I think there's focus on the vote split. Most people would expect 7-2 with Dingra and Taylor dissenting. There's probably some chance that you get a little bit more support for a cut today. And then focus will be on how they describe the economy. Mm-hmm. They will acknowledge that there has been progress with underlying inflation, with pay growth, but they will probably also note the upward pressure from energy prices. So I think, bottom line today for the Bank of England, that we are unlikely to see much of a shift, but we continue to think that they will cut in August. I think that now seems quite likely, and we think they will cut rates more than priced this year because rates are high. We are seeing progress on inflation, and we do ultimately think that tariffs are negative for the UK economy, for the European economy, and therefore rates will fall more in the UK.
Yeah, so Jari, actually, let's also bring Morwenna to talk about the Bank of England for the decision. I love our decision guides. Morwenna Konyam, of course, joining us. I mean, Jari beautifully laid out what we're expecting from the Bank of England. Again, it's a small open economy, so a little bit different to the ECB, and especially given the context that we've seen with the Swiss National Bank and Norges Bank, it'll be interesting to see how they're thinking of things.
Absolutely, because whilst all of these geopolitical risks are going to be hugely in play, particularly in terms of the trajectory going forward, there is the domestic economic situation to consider as well. And it is going to make things quite tricky for the MPC because we've seen evidence of sluggish growth. April GDP figure showed the biggest contraction in the economy for 18 months. We've seen softening in the labour market with job cuts, the most in May since the pandemic. But we've also seen CPI, inflation, staying elevated, 3.4% yesterday we saw. And, of course, those geopolitical risks, particularly with spiking crude prices, do pose a big upward risk to inflation going forward.
Yeah, Jari, is there a concern? I mean, inflation is taking its sweet time, actually, to show up in the real data. So the surveys kind of point to it. Is there a danger that we see the same in the UK, around the third quarter?
Yeah, I mean, we're going through a bit of a hump on inflation in the UK now from a headline perspective. I do think the rise in energy prices that we're seeing has the potential to prolong that hump a bit. But at the same time, I think we are now seeing quite clearly that the domestic price pressures, so on pay growth and on services inflation, are slowing. They're still high, no question about it, but they are coming down. And as was just said, the labour market is also showing signs of weakening. It's hard to read given all the data issues, but I think if you average across some of these indicators, you're clearly seeing a labour market that's slowing. And so I think rates are high for a reason because inflation is high, but we do think inflation will come down. And so I think there's a compelling case to then also expect rates to continue to come down in the UK.
Yeah, it seems pretty tough, actually, for Governor Bailey to navigate it going forward. And also the way that the voting system works in the UK makes it a little bit more difficult maybe to markets to really latch on like a main narrative.
Well, absolutely. And we have seen some surprises in the recent past. Economists are expecting today's vote to come in with a sort of 7-2 split, with the majority, of course, voting to hold the rate, but with 2 members voting for a quarter-point reduction. Of course, last meeting we saw a 3-way split with some members voting for a bigger cut. And there is some economists are saying that maybe another person might vote for a quarter-point cut this time round. So it will be interesting to see, and whether that's also seen as being a slight message as well. We've seen Catherine Mann, use her sort of activist position before to try and make a point about, what she sees the risks to be. So I think that, but also the commentary will be particularly crucial. We're not expecting any change, particularly obviously there's no actual forecasts. We think they'll probably keep their official forward guidance consistent at the sort of careful and gradual process of rate cuts. But in between the lines, the fine print, I think, could be quite interesting in terms of whether they put more weighting on those inflationary risks or the risk to, the challenges for growth in the domestic economy.
Morwenna, thanks so much. Morwenna Konyam, there are Markets Today editor. And so you're sticking, actually, Jari, in terms of forecast, sequential cuts. So once they start, it'll be, not as progressive as others think.
Yeah, I mean, we think the message today will continue to be gradual and careful towards quarterly. So we think that will then essentially hint towards August, that if we continue to make progress, we can then cut in August. And then we do think in the second half of the year, conditional on that inflation progress that we are seeing, we think there's a good chance that they speed up the rate cuts. Now, that's not what they're currently saying. So it really is based on our forecast of where we think the economy is headed, where we think inflation is headed, because we do have a weaker forecast for growth. We have more slowing in the labour market, and we do think pay growth and services inflation will come down more than the MPC expected in May. And so we have them cutting to 2.75% in sequential terms from September onwards.
Jari, I want to ask you a little bit about Norges Bank, because the euro has shot up against the Norwegian kroner because of this, surprise cut from Norway. They also were flagging the possibility of at least one more this year. I know this is a different economy and it's, different complex to the rest of Europe. But if Norway can do this, could we be surprised by other central banks?
So Norway was definitely surprising on the day. We hadn't expected that today. I don't think many people had, given the guidance. Now, at some level, of course, it makes sense that rates are high there. We had expected them to cut a fair amount later in the year, so they decided to front load it. But of course, the price of oil will also matter for them. So I think we need to monitor that. But as I said earlier, we do think there's generally still a bias across central banks in Europe for more cuts. We have one more cut from the SNB, so we do think they will go slightly negative. We have one more cut also from the ECB. They've, of course, said that, for now in a good place, but we do think that the trade tensions are ultimately going to force one more cut from them in September. And so I do think over the next few months we'll see rates coming down more across Europe.
Yeah, from the S&P, we're just getting some headlines saying the reason for the rate cut is lower inflation. And Mr. Slagle also saying they're not taking the decision to go negative lightly. The ECB has also a larger, I guess, concern because of the proximity to, countries that are more affected by Ukraine. Is this the most, after the Fed, the most complicated central bank to see what they do?
Probably right now, yes, because they've already cut a lot.
Yeah.
They're 2% down from 4%, and they're saying we're in a good place. We can afford to take a bit of time now. So it's not as obvious as it was a few months ago what they're going to do next. But I do think that the inflation dynamics in Europe look quite benign, and that is despite the increase in energy prices, because I think that will matter mainly for headline and not so much for core in Europe. And then on the trade front, obviously a lot of uncertainty, but we do think that we will ultimately get slightly higher tariffs than what the ECB staff assumed in the June projections, particularly for the tariffs on pharma that are quite sizable. We think there's a good chance that we'll get some announcements there in coming months, and the staff didn't include that in June. And so those are arguments, I think, for them to do one more cut in September. But as you said, it's no longer obvious because they've already come down to a level that's roughly neutral, whereas many other central banks, the Bank of England, Norges, and so on, are still clearly above what is a normal level. So it's a bit easier for those central banks.
Yeah, I keep on getting asked, how bad does the economy have to be to go below 2% interest rates? Jari, thank you so much, as always. Jari Stehn, he is Chief European Economist at Goldman Sachs. Now, coming up, we talk geopolitics, banking, and, of course, the debate around U.S. exceptionalism with Hugh Van Steenis from Oliver Wyman. That's next, and this is Bloomberg. Now, a new report explores whether the decades-long dominance of U.S. wholesale banks is at a risk in an era of geopolitical tensions and economic fragmentations. Well, I'm delighted personally to be joined by Hugh Van Steenis, partner and vice chair at Oliver Wyman, who published The Outlook with Morgan Stanley. Hugh, so good and so great to actually have you also on a busy day to try and understand some of the dynamics. But if you're a wholesale bank in the U.S. right now, you would have started January thinking like all gung-ho, it's going to be great, deregulation, I have so much to do. And now many more question marks.
Yeah, look, I think it's a very uncertain outlook. I think on the positive side, the volatility has helped the trading businesses for the US banks, and particularly FX volatility has been a huge boon. But obviously the expectations for deals, the uncertainty reinforced by the last week, has just meant that corporate activity has been pushed to the right. And so they're sitting there thinking, how can they really gain share in this environment? I do think, though, the deregulation agenda has got very strong winds in their sail, right. And I think that'll be very supportive for the banks over time.
But Hugh, I mean, you hear it in corridors, right, of chief executives in Europe saying, oh, we might get business because we're Europeans and not Americans. I just don't see it, right? I mean, the U.S. banks are still strong. They're frankly just very well organized.
That's right.
And so it's difficult to see the Europeans, unless we have a capital union or a banking union, to really come in and get market share.
I think that's right. I mean, look, the network effects of the large banks are super intense. Look, I think even if we do get a savings investment union, some of the US firms will benefit from that. Right. What was really striking 2 weeks ago at Super Return was how the US leaders in private credit and private markets were eyeing up the opportunities in Europe. I mean, actually, the securitization report, which came out this week, super nerdy, but actually was really quite a good step forward and actually went quite a bit further than consensus had expected. Probably not as far as you'd want, but actually that's positive. But I think the gravitational force of US banks is very strong.
I mean, do you think that actually US exceptionalism is really put into question, or is it just a buzzword right now?
Look, I think this is the tough call. It's come up a lot in our interviews with investors. I think the way I'd frame it is it's a bit like Apollo. Maybe the hyper-exceptionalism is coming back to just sheer exceptionalism, but the innovation and particularly the diversity of funding markets to support innovation in the States is something which we are still a long way behind in Europe. But, what I'm being struck by our interviews is how many chief investment officers are thinking about, reallocating a bit from US to Europe. And that's partly because they came into the year max overweight US, not just in equities, but also in currencies. There was a State Street survey showing that the dollar exposure was the highest for over 8 years. And so, of course, we've already seen a retrenching of that. And the more you've got a regulated pool of money, a pension fund or insurer, the more they absolutely have to increase their dollar hedging. Right. So I think you're getting some... I think about it as a rebalancing rather than an exodus.
Right, so it's not necessarily investors saying, look, we've always thought U.S. Treasuries were the perfect, we're safe, and now they're questioning that.
No, I think, so the way it felt to me is much more, so let's distinguish between the tactical trade around April, and in particular the first week of April, which we all remember was pretty yippee, exactly. Then some of this was FX risk. So imagine you're a Canadian investor. Well, you've probably lost 9% just on sort of currency and the move in that 1 week. So some of this was, if you see a risk, you need to take action. I think that was very much tactical. Yep. I think what we're now starting to see is investment committees debating the strategic asset allocation. And there, I think it's a much more gentle rebalancing conversation.
Yeah, I guess the concern here is that it started, with trade and tariffs, Liberation Day, then it gets extended. But you also have this whole geopolitics with what's happening in the Middle East. It could flare up elsewhere that I guess weighs on investors.
No, that's right. And so I think actually from the work we've just done in our survey, one of the big themes is the opportunity, let's say in Europe, a credit one or an equity one.
Right.
So actually, you can get, I think there was real conviction that with Germany spending money, with Europeans needing to invest in digital infrastructure, energy infrastructure, rearming, there's a huge opportunity for credit markets. Some will clearly flow to European banks, but also some of the private market players are super excited about private credit in Europe. On the equity side, I think, Francine, as you debate every day, the markets are, geopolitics does weigh on the markets heavily.
But private markets are also being open to retail investors more and more, so that will change the landscape forever.
Oh, I think this is one of the most interesting areas. In fact, the fastest growth in the investment industry is private credit to wealth. So we've just done some work showing, let's say in the States, the growth of evergreen funds. They're up 52% this year on Q1 last year. Okay. So it's a huge growth, and that's because the democratization of private assets, but it's been particularly been around credit. So in fact, one of the managers which just launched 2 weeks ago has raised $500 million in 2 weeks in their new fund. So it's really gaining traction, and I think you've got Greg Fleming coming to talk about later. But I think seeing how the wealthy are thinking about what is the right diversification of my portfolio, not just because of this year, but because of what happened in 2021. There's a reappraisal of diversification, and private credit is becoming probably a much more important part of that over the coming years. Yeah,
and it feels like it's changing really at pace. Hugh, thank you for joining us.
Pleasure.
As always, Hugh Van Steenis, partner and vice chair at Oliver Wyman. Coming up, we discuss the prospects for both the U.S. economy and the future of wealth management with, as Hugh was saying, Greg Fleming from Rockefeller Capital Management. That's coming up next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Senior U.S. officials are said to be preparing for a possible strike on Iran in the coming days. President Trump says he's keeping his options open. The Fed leaves interest rates unchanged, but warns that some of the impact of tariffs will fall on the U.S. consumer. Plus, after Switzerland cuts interest rates to zero, Norway delivers a surprise reduction. Investors also look ahead to today's decision from the Bank of England. So let's start with geopolitics, and Bloomberg has learned that senior U.S. officials are preparing for the possibility of a strike on Iran in the coming days. Now, this as the two sides continue to trade missiles, with Israel's defense minister instructing the military to intensify strikes against government targets in Tehran. Well, joining us now for more is our EMEA News Director, Roz Matheson. Roz, thank you for joining us. I mean, it just looks like things are escalating, and I'm always surprised hearing the president say, look, he'll make the decision at the last second whether the U.S. wants to get involved because everything's so fluid.
Well, that's right. Even yesterday he was saying, I may not. No one knows what I'm going to do. But it's interesting that there is some talk about the weekend, because that does give us 48 hours potentially to find some kind of off-ramp. So is this ramping up of rhetoric from the US, the signals they're preparing the possibility of direct strikes against Iran, is that to sort of push Iran to find an off-ramp in the next 48 hours? I mean, it's very difficult to see how that happens, or in what form that would take, or how Iran does that without losing face at home too much, having to essentially probably cede its nuclear ambitions, at least for now. So how do they do that? Do they do that through diplomatic channels or what? But it does give at least some window of opportunity here to find a way out before the US, does go towards the idea of direct action. But it does seem that that's very much on the table. They're making preparations for it, for plans of how they would do that, and that would bring the US directly in, obviously, then to the conflict.
Yeah, it's really interesting how various leaders have reacted, especially in the Middle East, which I'll ask you about in a second. But first, let's also listen to the Russian president.
The level of trust between our countries is rather high. We have very good relations with Iran. We could continue this work and ensure their interests in this area. I will not go into details now, as there are many. All these details have been discussed with both the Israeli and American sides, and we have sent certain signals to our Iranian friends. Overall, it is possible to ensure Iran's interests in the field of peaceful nuclear energy. At the same time, it is possible to address Israel's concerns regarding its security. In my opinion, such options exist.
So, Roz, overall, apart from Russia, how are leaders viewing this? No one's really condemning the Israeli attacks, but they're also worried about escalation, and some of them are pushing for a more diplomatic solution.
Well, that's right. So you've got European leaders obviously watching this with a high level of concern. We know the foreign ministers of Germany, France, UK are set to meet tomorrow with the Iranian foreign minister. The question is, can they do anything? I mean, it seems as though Benjamin Netanyahu made this decision himself to do this attack on Iran, even against perhaps the advice of the US. If Donald Trump can't change Netanyahu's behaviour, can anybody else change that behaviour? And so what is the role of Europe in this at all? Is it maybe to convince the Iranians to find an off-ramp? Who's talking to them to negotiate there? So maybe it's the Europeans, maybe it's some of the other Gulf states. They're obviously very worried because this is right on their doorstep. They wanted calm, peaceful times. They wanted to be able to do business, trade, investment. If this conflict spirals, all of that goes out the window.
Ross, thank you so much for the terrific briefing, as always. Ross Matheson, our EMEA News Director. Now, geopolitical upheaval is, of course, also weighing on investors around the world. Well, I could not be more delighted to get the view of Greg Fleming. He's president and chief executive of wealth management and financial services firm Rockefeller Capital Management, responsible for over $160 billion in client assets. Greg, thank you for joining us. Welcome to London and welcome to the Pulse.
Thank you.
I mean, there's just a lot. There's policy uncertainty on the geopolitical front, on tariff and trade coming from the U.S. How's it playing out in your world?
I would say there are two words I would use to describe the U.S. today. One is resilience and one is uncertainty. Let's start with the uncertainty. Clearly, the tariffs created a whole bunch of uncertainty way back in April. That's mostly still in play. You heard the Fed say that yesterday. And uncertainty is a challenge for both business and consumers because they can't predict. I mean, businesses are slow to make capital decisions. If supply chains have to be changed, they really don't know where to move the supply chains yet. And consumers are uncertain as well, given are prices going to go up, where are they going to go up? So that is a break on the economy, and I think you're seeing that. Having said that, the U.S. economy is still quite resilient. Employment, there's some weakness in employment, but it's hanging in there. Yep. Inflation is really the data has so far been under control. But again, you listened to the Fed yesterday. They're concerned about where it might go. So I think the summary I'd say is that the U.S. economy really is hanging in, despite all of the uncertainty created by all of the geopolitics. And obviously things going on in the Middle East now add to that uncertainty.
Greg, is there a worry that actually the U.S. economy is hanging on and then it goes badly all of a sudden? I know Jay Powell yesterday, to me, felt like he was really warning on inflation. But there's such a difference between what surveys are telling us on inflation, the economy, and real data. Does that match up at some point?
Well, that's actually a really good point, Francine. The data is not there yet. I mean, inflation is still in check. And having said that, there are clearly inflationary things in motion, like tariffs. I think the tariffs, the effective tariff rate in Trump 1 before they made the changes in his first administration was 1%. It went to 2.5%. It's 14 today. So that's a significant move on the tariff front. But when you pull it all back together, and the Fed said it again yesterday, they're not clear on where it's going, and they're trying to balance the two. Francine, the word that the Fed is most focused on, which would be the biggest challenge for the U.S. economy, is stagflation. They don't want to see that unemployment rate tick up and the economy really start to slow when at the same time inflation starts to kick in because of a delayed effect of tariffs. And let's talk about the fiscal situation in the U.S. too. There's a budget bill on the table that will keep the deficit at roughly 6% of GDP. That's very stimulating and inflationary as well. So they're worried that inflation might tick up as the economy slows, and then they've got both problems and that word that we haven't seen in the U.S. in decades, stagflation.
That's a nightmare. I mean, we don't even pronounce the word because people are so scared of it.
Yes.
I mean, so if you're the Fed right now, how do you operate it? Is it in a wait and see, or is there anything that they can do now to actually get up front of it?
They need to do what they're doing, which is wait and see. And they're just not sure. And actually, the language yesterday was more direct on that point than you've seen in a while. It is a very uncertain world. They want to wait and see what happens, so they're going to figure out which way to pivot based upon what comes in. I would guess that they probably don't move until late in the year, because unless they see something clear, because they are reading the data. So unless there's something that actually tips them in one direction or another, they're going to continue to stay on the sidelines, monitor, and react to real events as opposed to things that they can't see yet.
Greg, I guess your main job is to interpret and action some of the big changes that we're facing. Sure, you're a very busy man, but there's a lot of concern about Treasury auctions, debt. Do you think the U.S. will be able to grow itself out of the fiscal situation? And we haven't even talked about AI.
Yeah. Well, let's get to AI, because if we're going to grow our way out of the fiscal situation, AI will be a big part of that. But the deficit is a big issue. Between 1945 and 2024, receipts as a percentage of GDP in the U.S. were 17%, effectively taxes. Spending was 19%. So you had deficits, but they were relatively constrained. When Bill Clinton left office in the late 1990s, 2000, we had surpluses. In the 5 years from 2019 to 2024, receipts were 17% of GDP, and spending was 27%. That's unsustainable, even in an economy like the U.S. So, yes, we can grow our way out of a lot of it, and AI is going to be a big part of that. But we really need to do a better job of constraining that 6% as a percentage of GDP deficit year in and year out. You just can't keep doing that.
But there are also so many questions about whether the U.S. can be a reliable ally. There are questions about, is there U.S. exceptionalism? So is there going to be enough growth in the U.S. to put all of those bad mouths to one side? The
U.S. is going to stay the strongest economy in the world. It's a dynamic place where entrepreneurs create new businesses every year. There are 3 or 4 million new businesses created in the U.S. every year. Secretary Bessent, early in the administration, said they were targeting 3% real growth, 3% inflation, and a 3% budget deficit. If they hit those numbers, the U.S. will do really well moving forward. And the 3% real growth is a very high number relative to anything we've seen for decades. AI is truly transformational. I mean, I'm seeing it in our business, seeing it in all the businesses of the clients that we provide advice to. So you could, with AI, get to 3% real growth.
How do you use it? AI?
We use it for everything from drafting emails to clients, where they can look at the history of the dialogue and write something that's terrific, to looking at investment performance. I mean, it is going to transform the wealth management business. But every single business in every single industry over the next 5 or 10 years will be transformed by AI.
Yeah, transformed, or, I mean, some companies could also have a Kodak moment where they kind of lose, they become completely irrelevant. Do you think enough chief executives and boards are having that conversation?
I do, but Francine, one thing I'll say about new technologies, and my colleague Rashir Sharma, who's our chairman of Rockefeller International, has done a lot of research on this. There has never been a new breakthrough technology that has cost more jobs than it's created. So if you look at the internet in the late 90s, today we have things called search optimization engineers, something that nobody conceived of in the late 90s. So, we believe on balance that AI will create lots of change and it will eliminate jobs. But the productivity improvement and the ways that it helps transform business businesses we have no idea of now going forward. So on balance, when you have a breakthrough technology, it's better for the economy in the U.S. and around the world.
Okay, that's I like it. An optimistic guide to AI.
It is an optimistic view on AI.
Greg, when you look at some of how basically people deploy capital, so it could be chief executives investing. I know there's a lot of a big chunk of money that's going to AI, but in general, it's also companies not wanting to list, being more private. Resurgence of credit. Does that change again how investors and clients see the world? If more companies want just to be private instead of public?
100%. For our clients, and remember, our clients, we focus on high net worth and ultra high net worth, primarily Americans today, with offices across the country. We have increased the allocation within the asset allocation for those clients to private alternatives.
Right.
Because these clients are wealthy enough to withstand the illiquidity discount of privates and alternatives. And there's been enormous growth in private and private alternatives available to clients across all the different asset classes, from PE to private credit. I mean, you're familiar with all of them. So that is a long-term secular change in the way certainly high net worth and ultra high net worth clients should invest.
Does Europe gain in these trade and tariff uncertainties? Or do clients want to be more invested in Europe?
Well, one thing I'll say, coming into the year, and there's this whole discussion of American exceptionalism. American exceptionalism is real, but it went very far. So 70% of global market capitalization at the end of last year was the American stock markets. That's on the high side in any historical context. So there was going to be some correction and the U.S. also had over 50% increase in the stock market in the 2 years in 23 and 24. The last time we saw that was 98 and 99. So no matter what happened with the new administration coming in, even if the whole tariff situation hadn't occurred, there was likely to be an adjustment, and international markets were going to do better. Part of what we've seen in international markets outperforming U.S. markets is that. But we believe that American exceptionalism is here, as I talked about the entrepreneurialism, that's going to continue for a long time.
Even if China wins the AI race. We haven't talked about China.
Well, the AI race is very important to win. And I think the American economy is still leading in that. And this is why private investment in the entrepreneurialism of the U.S., that's a really important part of the American economy. Small business, people forget that 60 million Americans work in businesses with fewer than 500 employees. There are 33 million businesses in the United States with fewer than 500 employees. And that dynamic startup mindset, as I said, 3 or 4 million new companies created every year, that's powerful. No country in the world has that. And as long as that continues, you're going to see innovation and entrepreneurialism driving the American economy and hopefully keeping our lead in things like AI.
Greg, thank you so much for joining us. A real pleasure to host you.
Great to be here, Francine.
Greg Fleming, Rockefeller Capital Management President and Chief Executive. Now let's also shift the focus to tech. Well, back to tech. Bloomberg has learned that Microsoft is planning to cut thousands of jobs as the firm continues heavy spending on AI. Well, Charlie Wells is here with the latest. Charlie, good morning. So tell me about Microsoft. It's trimming its workforce.
Good morning, Francine. So Bloomberg has learned that these job cuts would focus primarily on sales roles. That's according to people familiar with the matter. And it follows some 6,000 cuts that went into effect in May that really targeted more of the product and engineering side of the workforce there. And this comes at a time when Microsoft has been investing significantly in AI. Wall Street has liked what it's hearing on the AI investment front, but Microsoft has also had to communicate that it intends to keep a lid on costs. And this is where we're seeing some of these reductions in the workforce.
So, Charlie, on the topic of tech jobs, Bloomberg has also learned that Amazon will be ordering some employees to move closer to their managers. What's the rationale behind that?
Francine, so this is related in some ways in trying to keep a lid on those costs as well. And we know that some of these jobs would actually be required to move closer to their managers. So Amazon earlier this year implemented a policy that staff had to return to office 5 days a week, but they did not have location specificity. So this adds that specificity to that mandate. So people who may be working out of satellite offices across the United States at Amazon in cities like Dallas or Austin or Boston might be required to move to places like Seattle, more hub locations such as Seattle or Washington, D.C. Now, Amazon has said that it does not take a universal approach here. They're going kind of one by one, and that teams have been moving closer together. But this is according to people familiar with the matter who say that this could disrupt people who have been working out of a lot of these satellite offices for years.
Charlie, we're also learning that OpenAI is phasing out its work with Scale AI. Why?
Well, the gloves are off in that race for AI dominance, Francine. And basically, this is following news that Meta invested some $14.3 billion in Scale AI. Now, OpenAI has said that its data needs have changed, that they are not as reliant on Scale AI's data labeling technologies. But there has been concern following that significant investment from Meta and the 49% stake that Meta took in Scale AI, that could give Scale AI access or at least exposure to competitors, including OpenAI or Google. So this could be a shift, and it could create some problems for Scale AI as they take that investment from Meta.
Charlie, thank you so much. Charlie Wells there with the very latest, of course, on some of the tech stories. Now, coming up, LVMH confronts one of the worst crises in its history. We'll break down the multiple challenges at the luxury giant. That's next, and this is Bloomberg. Hi, everyone. Now, a 220 billion euro slump in market value is heaping pressure on LVMH founder Bernard Arnault. A widespread luxury slowdown and succession concerns are adding to what one analyst is calling the biggest crisis in the firm's history. Now, it's a subject of today's Big Take, and Angelina Rasquet is in Paris to talk us through it. Angelina, thank you so much for joining us. Now, you wrote this Big Take. It's extremely interesting, extremely timely, and it's about the challenges right now at LVMH. There are many. What are they?
Hi there, Francine. Well, indeed, I mean, the backdrop is that there's a big slowdown in the luxury industry that's affecting all the companies. Where, the two biggest engines of growth, the U.S. and China, are suffering, but there are internal problems to LVMH, and notably at two key assets that we focus on. That's Jari and also Moet Hennessy, the alcoholic, the wines and spirits unit. They've been both culprits in recent years of hiking prices too much. So there's been a consumer backlash. At Jari, there was also last year a supply chain scandal that generated a lot of bad press. So these are some of the biggest problems. So in the past 2 years, since LVMH shares reached a record in April 2023, they've lost about half of their value. But that hasn't prevented Bernard Arnault and his family from buying about more than 1 billion euros worth of their stock.
Angelina, tell us a little bit more about the conglomerate discount and what you found.
Indeed, Francine, well, LVMH is a group that's composed of 75 brands. And when you have a rising market, maybe investors are more willing to ignore the fact that it's, it owns companies that have that are in different industries, whether it's hotels or wines and spirits or leather goods, but also restaurants. But basically, these assets have different valuations and different margins. However, when things start to become more shaky, then there's probably more scrutiny. And what we found out is that in recent years, LVMH actually considered spinning off Sephora and listing it in Amsterdam. That was in 2021. And Diageo, which owns a stake in Moet Hennessy, 34% stake, they also asked about 2 years ago to also list the unit, but Arnault dismissed that idea.
So what are people saying about succession and governance?
Well, that's another topic that's on investors' mind. Bernard Arnault controls LVMH. He's 76. Recently, he lifted the age cap of the CEO from 80 to 85, signaling that he intends to lead the company for the foreseeable future. All his children, he's got 5 children, they're all involved in the business and they all have prominent roles, but there's not an obvious successor there. Last year, he named a deputy who's still relatively unknown to the markets and to investors. His name is Stéphane Bianchi. He's 60, and his career, basically his track record was leading family businesses, much smaller than LVMH, but also mentoring heirs.
And meanwhile, I mean, there was big news earlier this week with Kering actually hiring a former Renault chief executive, Luca de Meo's. I mean, it's quite unusual to have, the chief executive of a car maker going to a big luxury company.
Yeah, that was a major surprise, Francine. Generally, the luxury sector functions in a closed circuit. I mean, in recent years, it also hired people from the fast consumer goods, whether it's Unilever or Procter & Gamble. But really going from the automaker industry, that was really surprising. But Luca de Meo's track record at Renault is second to none. He stayed there for 5 years, and shares simply doubled. He managed a turnaround, and that's probably what François-Henri Pinault is hoping that he will do at Kering, which is really struggling with its turnaround, and especially of its biggest brand, Gucci.
Angelina, thank you so much. Angelina Rasquet there with the very latest. Now, Chinese EV maker BYD's aggressive push into Europe is seeing results, with sales growing more than 200% in the first 4 months of this year in the region's 5 biggest markets.
For BYD ourselves, we are still in the fast-growing pace because, like a Q1 of our UK sales is higher than total of 2024. So even in May, all the auto industries dropped by between 5 to 10%, but the BYD still kept like a 200%, 300% growth in different countries.
Well, that was BYD's Executive Vice President, Stella Lee, speaking to our Tom McKenzie. He joins us now. So, Tom, thank you for joining us. How important is the European market for BYD?
Well, Stella Lee told me that Europe is its now most important market. They're going to commit $20 billion equivalent in terms of investments here. They're building out a factory in Hungary. They're hiring pretty aggressively in terms of top talent from the incumbent European automakers. And you've seen this incredible growth in sales in recent months, a quadrupling in so far, year to date, in terms of sales into countries like Germany, France, Italy, Spain, and the UK. And the UK now is its strongest market. In fact, it's outdoing, in terms of recent sales, outdoing the likes of Fiat, Honda, and even Mini as well. One of the aspects going forward for BYD is the pricing story. It's very aggressive on pricing, but it's also betting on the dealerships and on its tech, on winning over consumers. And broadly across Europe, it is now selling more electric vehicles than Tesla.
What are the challenges?
There are challenges for BYD. And part of it goes to the pricing story because as a result of that very aggressive pricing, they are on razor-thin margins. The other challenge is winning over customers and dealerships, winning them over on the question of quality. They have the supply chain, everything from batteries all the way to the actual shipping as well. They think that's put them in advantage. And Stella Lee told me when they bet on something, they go in big. They're going to put all their resources into Europe. But the challenges are there.
Tom, thank you so much. As always, Tom McKenzie there with the very latest on BYD. You can catch also Tom tomorrow for Bloomberg Tech Europe, which debuts 6:30 a.m. UK time on Bloomberg TV. The show, of course, spotlights the biggest names and key trends shaping the European tech ecosystem every month. Up next, Bloomberg Markets, and this is Bloomberg.